This week in economics, the macroeconomics program from WBRN Radio and on the Bostonred Network. This is the Numbers Man, part of our family of presentations on the 14th of October 2018. We'll look at a number of things here, just looking at the script. We'll address consumer confidence from the University of Michigan. And also, we'll look at real earnings for September. That was released on the 11th of October. The Consumer Price Index, we'll delve there. And we'll, let me get ahead of myself a little bit here. The economy, where it is, what the Trump administration thinks about the independence of the Fed. And we'll also look at the international situation as far as petroleum is concerned from the International Energy Agency. And we'll see where that is going. And the basic forecast for petroleum. Cut in demand of oil, but see oil petro forecast, but see demand staying high. I'm just running some of the headlines here. And we'll look at Facebook and how it affects Facebook's stock. They have now said that there were 29 million people breached. If you recall, the report was 50 million, but again, we won't quibble there. And the retailer Sears, that used to be king of the road, so to speak, and what Wells Fargo, and it's pretty much a pattern of these corporations, including Ford, that are making redundancies in the future year and some this year also. So let's get back to the IMF. We'll go to it. Normally what we would do here, we would append the comments by Madame Lagarde on the end of the forecast, but on the end, of the broadcast. But what we will do now is we'll give you a little sampling. This was a global meeting in Bali, Indonesia. And there was a quake there. I bet people awoke to, but it obviously didn't wash the IMF away. But we'll see where the global economy is going, because this is a global economy. Then we'll come back and look at the current statistical roundup, so to speak. And we always look at commodity pricing, the markets, where they are from the past weeks. As usual, we partner with Cranston Analytics, and we'll give you a little view of what we think about the economy. But firstly, hear from Madame Lagarde and her news conference in Bali.
If that's the right word, commemorating the 10-year anniversary of the Lehman failure and the maximum point of financial chaos, the economic chaos, disaster was to come follow. What are the things now, 10 years later, that worry you most? I noticed in the World Economic Outlook that it now says that downside risks dominate again. It's a real shift in the last 6 months. So what are the things that you look, when you look at around now in terms of the condition of the world economy and the repair after the crisis, that concern you most?
Thank you, Martin. And I'm going to give you the conventional wisdom answer that is prescribed by the IMF, and then I'll tell you what I really feel about.
Okay. Get through the first part quickly. We know that.
Now, in terms of risks, and we have seen some of those risks that we identified during the spring materialize, particularly in relation to trade. But those risks are, number one, consequences of legitimate and necessary monetary tightening and how it impacts emerging market economies, low-income and developing countries, particularly given that many of them have actually taken advantage of low financing cost to borrow in often dollar-denominated loans. That's number one. Number two, geopolitical risks or crisis that abound, but that's not a new development. We always have a geopolitical development. At the moment, they certainly are there. And the third one, which is related to trade, is one that is really a big question mark, because it is a disruption from a system that has been in place for a long time, which was multilateral, which brought people together, which has its downside, its defects, which needs resetting in many ways, which needs more flexibility as well. But the level of uncertainty combined with the first point that I made is really a new environment in which emerging markets in particular have to really respond using all the tools in their box. Now, if I give you my personal worry, it's only a fear. It's not something that is happening. But I really hope that we are not all victim of this sort of collective amnesia about what happened 10 years ago or what happened way before that, when protectionism was rising and where geopolitical tensions combined with that rise of protectionism produced terrible developments. Amnesia plus fear about the future, which leads us to not really focusing on major issues such as climate change and its impact, such as the risk that excessive inequality can bring to bear not only on growth, as we have demonstrated, but on the strength and composition and chemistry of our societies. So that's some sort of an accelerated Alzheimer that we would be the victim of.
When you're referring to previous periods when protectionism got out of hand, were you actually talking then about the pre-war period? Or yes. I mean, the crucial point, of course, was that it was against that backdrop that the Bretton Woods Conference was created. The decision to create a trade organization really went along with it. So are you suggesting in some profound way that there are challenges to the entire global system of cooperation, of which the IMF is a representative and a symbol?
I think that the IMF at the moment is not on the radar screen, if you will, but the IMF was certainly one of those institutions that were built at the time in 1944 to really develop multilateralism with a view to avoiding those conflicts and those terrible destructions that we saw during the Second World War. I think the way it was structured by the Founding Fathers, with weighted voting mechanisms, with a formula evolution that was embedded in the articles, has made our institution, the IMF, stronger than others. And, you know, we discussed the situation of the WTO, which was also an evolution of the GATT decided in 1944. There is rigidity in the functioning of the WTO, which clearly can lead to it being more crippled than an institution that has flexibility, that has evolution as part of its own system. And I think that's where we should really focus the effort.
Let me just ask one follow-up question, which is a difficult one, but I think is sort of cannot be avoided in this context. It is obvious to anybody here that some really quite profound tensions of various kinds are emerging between the US and China. These are two enormous players, the incumbent superpower, if you like, and the ascendant one. Is it possible, in your view, for a really important multilateral institution like the Fund, the WTO is another example, you were moderating a panel on that, to function properly in an environment in which there is so much tension between two such immensely important players in the system?
I guess it would be a difficult exercise, but I hope not an impossible one, particularly if we can constitute that forum where parties that do not agree are prepared to look honestly at the issues and appreciate the consequences of the tensions that are being created. So I very much hope that the IMF can participate in that exercise and be that forum where people actually talk and explore avenues to resolve the tensions that have escalated.
So one of the ideas, but this is more relevant to the WTO context, and I'll move on to you, is a sort of if you like, if I may use the phrase, a coalition of the willing. The people who want to proceed forward, even if it does include everybody, and this is clearly what's happening in climate too, which you mentioned, would proceed, and maybe the US at the moment would not want to participate, but might change its mind in future. Do you think this is something that essentially we in the world will have to think about seriously across quite a range of things? Trade, climate, maybe other areas, monetary cooperation?
I think if you look at the TPP, for instance, this is clearly the route
interesting
that
example
has been taken for a plurilateral agreement that was intended for 12 and that is eventually settled for 11. Might be a 12 one if the UK decided to join, but that's another story. In terms of international monetary order, I don't see how that order could continue to operate, be governed and organized without the reserve currency of the world, and that is the US dollar. So I think that we should make every effort to include all the players at the table and find avenues to reach settlement on those debated issues.
And certainly there's nothing we've seen in the last decade, rather the contrary, to suggest that the dollar's position will be dethroned in the near future or even in the longer term future.
I think you're right, and I don't see any currency that is at the moment willing to go in that direction and to assume the liabilities and responsibilities that go with it. No.
And it won't be the SDR either. Let me move on to where we started. You mentioned quite a number of concerns, the vulnerability of emerging economies that have taken on a lot of dollar debt in various forms, and we're so familiar with the effects of a stronger dollar and rising currency and rising interest rates. We have the trade issue, very big one, weaknesses in the global financial system, huge amounts of debt out there, and of course you have more recent ones, the oil price rise, very significant. But if you look at some of these things, the global financial system, the vulnerability of emerging economies and so forth, how much would you attribute this to errors made of commission or omission by key policy makers and advisors, including the IMF itself? Have you warned, for example, something that concerns me a lot, have you warned emerging economies, in your view, enough of the dangers of recreating the sort of balance sheet vulnerabilities we saw in the 90s? Do you feel happy with what you've been doing, in other words?
Well, I'm never happy because we can always do better. But when I look at the alert that we launched about a year ago now, actually before that, because I remember that conference that we gave in Mozambique, and it was initially going to be Africa Rising. And I remember discussing that with the African department and saying, is it just Africa Rising, or should not be as well Africa Watching? And we did actually change that conference to Africa Rising, Africa Watching, meaning watch out, because you are currently courted by all those investors and all those financial people who want yields out of those bonds that they're going to place for you. And if you do that in another currency than yours, it's going to expose you to significant movements going forward. So we did that. And about a year ago, we also raised the alarm and said, watch out, debt is up. The $160 billion figure that we mentioned about a year ago was mentioned by the Fiscal Affairs Department of the IMF. So I think on the debt front, we've been quite vocal about the rising risks that came from that facility, and it was a facility. Still is for some countries, by the way.
One of the really big dilemmas that you as advisors have faced is thinking about the monetary policies of developed countries. So you have taken the view, I've agreed with it, so I claim that it was right and proper to pursue these extremely expansionary, including unconventional monetary policies to secure a recovery. Of course, many in emerging markets, some of them very distinguished, for instance, Raghuram Rajan, when he was governor of the Reserve Bank, argued that this was profoundly dangerous for the emerging world, and that it would lead to exactly what we are now seeing. Do you feel completely sure now, looking at the advice you gave and the consequences, you look at all the emerging countries under pressure now, that you gave the right advice?
Well, we have to look at the counterfactual. What would have happened had it not been for those accommodative monetary policies? And what kind of financial and economic crisis would have the world faced had that not happened? And I think that the answer, probably, it's difficult with counterfactuals, but the answer would have been a lot worse, and a lot worse for emerging market economies and for low-income and developing countries as well. So yes, it is not ideal, and the volume of, the size of the balance sheet of many of the large central banks is an issue that needs to be addressed, and the way in which those instruments will come to maturity will be, sort of resolved by a variety of mechanisms, I suppose, is a critical issue on the one hand. On the other hand, the emerging market economies and the low-income and developing countries are going to have to use all the tools in their toolbox to resist the consequences of what inevitably will happen, which is this outflow of capitals that came to the emerging and low-income countries sometimes in search for yield.
Should the IMF be arguing far more strongly than it is in favour of a really tight inflow capital controls in emerging economies?
That's a question.
And, the authorities of some very important countries, China and India, for example, clearly believe they have been helped by being able to regulate quite closely, with varying degrees of success, the inflow, and then, of course, it makes it easier to manage the outflow of capital. And the vulnerability of the Latin American region, for example, reflects their relatively somewhat more laissez-faire stance. Should you be, I know over the last 20 years, since the Asian financial crisis, the fund has been going there, but it's still very cautious. Should you be much stronger and say this is actually poison?
It's the whole debate about the capital flow management measures. Yeah. And are they legitimate to support the overall system, and if so, when and at what point? And I think the institutional view that we have reached back in 2012, and which has recently been confirmed in 2016 when we put it back to the international community, was that capital flow management measures should not be the first order of priority, and should only be used in exceptional circumstances, in case of imminent crisis or crisis development, and should not be a substitute for macroeconomic and macroprudential measures. This has been the policy, and this has been the institutional view which had to rally the consensus around all the members, so that the international monetary system and the way in which capital flow around the world be an agreed framework. I think that it's certainly a view that needs to be supported by actual real-life policies, developments, circumstances. And I know that in this part of the world, in Southeast Asia in particular, some of the policymakers are very concerned about being able to possibly use capital flow management measures in a slightly more flexible way. I think the view of the IMF, and that's the beauty of it, is that it is not a rigid, codified set of rules. It has a degree of flexibility, and it tolerates capital flow management measures in certain circumstances that are assessed on a country.
We leave the conversation with Madame Lagarde. That was Martin Wolf from the Financial Times. Capital flow, management of capital flow, where do the emerging markets stand in this scenario? The International Monetary Fund obviously has made some mistakes in terms of using austerity measures, or forcing them, I should say, on developing countries, and the whole regiment that they're using. Madame Lagarde commented on the sector of the Americas, commonly called the Latin American countries, And there are more laissez-faire movements in such countries as China, a more managed approach. We at this mic feel that the more managed approach is the proper approach. And also, one other comment, we'll leave this where it is the emerging markets and these various developed banking operations sponsoring the selling of their bonds. Now, the problem is in the answer if they are selling bonds in their currencies or if they are selling based on the dollar, the sovereign, the dollar. And another disagreement there, the U.S. dollar is reigning now, but will this last, say, in 15 to 20 years? The answer to that is no, based upon the current track of monetary affairs. We'll leave this where it is and move very quickly to real earnings in September of 2018. This is released from the Bureau of Labor Statistics. We are appreciative of this on Thursday, the 11th of October. Real hourly earnings for all workers increased 0.3% from August to September. Seasonally adjusted, the Bureau of Labor Statistics reported. The results stem from a 0.3% increase in average hourly earnings combined with a 0.1% increase in consumer price index for all urban consumers. Real hourly earnings increased 0.2% over the month due to increase in real average hourly earnings combined with no change in average work week. The real average hourly earnings increased 0.5% seasonally adjusted from September of 2017 to September of 2018. Real hourly average earnings combined for 0.6% increase in average work week, resulting in a 1% increase in real weekly wages over the period. Real average hourly earnings for production and non-supervisor workers increased 0.2% from August to September, and seasonally adjusted results stems from a 0.3% increase in average hours. The earnings combined with no change in the consumer price index for urban workers. Combining real average hourly earnings with no change in weekly hours and real average weekly earnings as 0.2% overall. So this is basically where things stand. If we look at the average hourly earnings in September 2017, $10.78, and in July of 2018, I think we went through this, 2018, $10.77. In August, $10.78. You can see there's very, very little flexibility here. This is the real average weekly earnings at $369.04. That was in September of last year. In September of this year, it is $372.94. The consumer index, price index for all urban consumers, if we look at that, 1 year ago it was, in September, it was 246.392, and in September 251.994. So the average hourly earnings, now a little different here, would be $26.51. That was in September of last year. In September of this year, that was at $27.24. Now the average weekly hours was 34.3 in 2017, September 2017, and 34.5 this year. The average weekly earning in September 2017 was $909.29, and this September it's $939.78. Roughly, let's see where we're going here with this, $30 difference there. And I think well, if we looked at this consistent $82 to $84 earning for production workers, the real average was at $9, and that was in September, $9.23, and $9.23 and $9.27 this year. And it would have been $22.20, the average hourly earning here, not the real average, and it would be $22.81. And the weekly earning would be $745.92. That would have been in September of last year, as opposed to $768.70 there. So roughly a little over $20 more there. So that's some of where people actually are. And let's go now to the Consumer Price Index that was released also on the 11th. This is for September 2018. For urban consumers, it increased at 0.1% in September over seasonally adjusted basis after rising 0.2 in August. Over the 12 months, all items index rose 2.3% before a seasonally adjusted. Whoa, sorry about that. My pointer escaped me here, so let me just get back to the narrative. The shelter index continues to rise, accounts for over half of the seasonally adjusted monthly increase in all items index. The energy index declined 0.5% in September after rising in August. The food index was unchanged in September. And the food away from home offset a decline in the food at home index. The all items less food and energy rose 0.1% in September, the same increase in August. Shelter index at 0.2%. Index for apparel, motor vehicle insurance, recreation, airfares also rose. Medical care index increased as well, though the components were mixed. The index for used cars, trucks, which fell sharply, and new vehicle index were among the indexes that declined in September. Items for all indexes rose at 2.3 for the 12 months, smallest increase than the 2.7 for 12 months ending in August. The energy index rose 4.8% over the last year, notably a smaller increase than the 10.2% for 12-month period ending in August. The index for all items less food was 2.2% for 12 months. So we will impinge of this particular index here, and as it goes into, let's see, if we look at food, there was a 0.1% in it. Food away from home at 0. Oh, wait a minute, excuse me. Food from, let me just make sure I'm getting across here. Food at home, sorry about that. That was a negative 1%. Negative 1% food away from home. Energy as a commodity, -2. Gasoline at -2 there. Fuel oil at 3%. Electricity -8. Utilities negative there, and a negative 0.5 tenths. Commodities, less food. Let's see here. I think we already talked about new vehicles, negative 0.3, apparel at a negative 0.1, and a negative 0.3 for used cars and trucks. And medical commodities a negative 1. Services less energy and a 0.2 tenths. Shelter at 0.2 tenths. Transportation at a 0.5, and medical care services at 2. Let me just make sure of it. At 2 tenths. Okay. Food index was unchanged. The index for food at home, which was unchanged in August, fell 0.1% in September, with major grocery store groups. Mixed index for meat, poultry, eggs, and fish fell 1% in September. All major component index falling. The fruits and vegetables index also fell, declining 0.5%. The index for dairy and related products declined 0.3%. Index for cereal and baked products increased at 0.6%, as did the index for non-alcoholic beverages. That would be tonics or various sodas, etc. Index for other foods at home rose 0.2%. Index for food away from home rose 0.2% in September, the same as in August. The food index rose 1.4% over 12 months. The index food away from home rose 2.6%, and food at home index 4%. Major grocery store groups index rose modestly over the period, except for dairy. Energy declined 0.5%. Some of this is a little bit redundant here. The energy index increased at 4.8% over the past year. The index for oil rose sharply, increasing 23.4%. The gasoline index rose 9.1% over the last 12 months, while electricity and natural gas declined there. And this is basically a rehash of the chart. The consumer price index for all urban consumers increased 2.3% over 12 months. The consumer price index for urban wage earners and clerical workers increased 2.3% over 12 months. The channeled consumer price index for all urban consumers increased at 2% over 12 months. So the next consumer price index for October will be released on Wednesday, November the 14th. So that eliminates that part of it. Let's look at consumer confidence. That also came out for October. This is a preliminary result, incidentally. October 2018 at 99. It was at 100.1 in September, and 101.7 in October of 2017, a negative 1.1 change year over year, negative 1.7 from, and the current economic condition at 114.4. Last month it was 115.2, and last year it was 116.5, a change of 0.7% in the negative. The index of consumers at 89.1. It was 90.5 in September, and 90.5 also last year. From Dr. Curtin, who heads the survey, current consumer sentiment slipped in October, although it remains quite at favorable levels, just above the average reading during 2018. The small decline was due to less favorable assessment by consumers of their personal finances. Unfortunately, the downward revisions in rate of growth in household incomes were accompanied by an upward revision in the year-over-year expected inflation rate. Weaker real income expectations. It should also be noted that the standard sell-off in the equities, the stock market, overlapped, intervening by one evening, having virtually no influence on the early October data. Well, in other words, we'll get that later with the next issue. In addition, there was no evidence of a spillover from the Kavanaugh hearings to economic prospects. It's interesting he put that in. Indeed, confidence in government economic policies rose in October to its highest level in 15 years. The strong performance of the national economy, most October gain was due to upward adjustment by Democrats, although their evaluations were still well below the much more favorable evaluations of Republicans. When asked about the upcoming election, its potential impact on their personal finances and on the overall economy, consumers more frequently cited Republicans and Democrats as having a positive effect, with a margin of 35 versus 26, the overall economy, and 34 versus 24 for their personal finances. A substantial portion, however, replied that there was no difference from the overall economy, 36% of their finding. And that's kind of interesting there. We don't have the expectations. But basically said his next release will be on October 26th, the final October data, that'll be at 10 a.m. That's kind of interesting in that they actually put the political factor in here at WBRN and on the Bostonred Network. We're doing the numbers man section, which is macroeconomics, but we do Bostonred, original title of it, the political part of our arsenal, so to speak, where we would talk probably about this, which we shall on our next program, is the Money Quarterback, the economic indications, if there are any. But however, though, in the latest polling, we're looking at a battle tracker poll, and healthcare is the number one issue. Now, this, we did not go into that, so we'll just move on like good economists should do. And we'll head to Bloomberg now. And interesting little note here, 3% of U.S. taxpayers pay the majority of income tax in 2016. Individual income taxes are the federal government's single biggest revenue source in fiscal 2018, which end in September on the 30th. Individual income tax expected to bring in roughly $1.7 trillion, or about half of all federal revenues. In the past, statistics can offer any guide. 1.44 trillion in taxes were paid by 140.9 million taxpayers, reporting a total of 10.2 trillion in adjusted gross income. Very interesting. The top 1% paid the greatest share of individual tax at 37.3. Then the bottom 90% paid a combination of 30.5%. The top 50% of all taxpayers paid 97% of the total income tax, individual income tax. In other words, the bottom 50 paid 3%, while the small percentage of taxpayers also paid 3% or more. You might have guessed the top 0.11% are 1,400 taxpayers. That group paid 3.2% of all income tax in 2012. The bottom percentage group paid 5%, whereas the top filers paid 2.3% of income tax. And it's it tells you how things have been have changed in terms of what different percentages, small percentage group of taxpayers also paid 3% or more. You might guess at the top are about 1,400 taxpayers. Individual tax systems are designed to be progressive, those at higher income rates, while indentation or reduction in the steepness of the progressive curve visible at the higher levels. And this is a very good article. I think we'll append this because it's something to see. The average tax rate paid for very wealthy has fallen in recent years from a peak of 24.1% in 2013 to 22.9 in 16, and a full point, below the 26.9% on the average. To put these numbers in perspective, we talked about this. The top not 0.1% of taxpayers consisted of roughly 1,400. The top percentage equaled 1.4 million returns, and the top 50% is half of the 140.9 million. So this is an interesting article. Just informs things where places are. A note here on the Fed: the Trump administration for Credlow is a so-called economic advisor anyway, basically said that DJ Trump called the Fed's monetary policy crazy. And this is kind of interesting. The president, as a successful business type and investor, knows lots about these topics, and he gives his opinion. He's concerned the Fed might be moving too quickly and choking off the recovery. Again, the Fed has raised rates 6 times since DJ Trump took office, and slated to raise it one more time. But one has to understand the type of economic program America First has created jobs in certain sectors and in certain geographical areas, but also the various demands, the campaign for 15, etc. Now the behemoth Amazon is raising, starting in November, it'll be a few weeks off, the hourly rate to $15 an hour. Now in some areas they're already above $15 an hour, but there will be some wage inflation there, whereas other workers, 31,000 steel workers in Pennsylvania, Ohio, etc., they are negotiating for raises in their contract. That's the old argument: you raise the levels of wages, there will be some wage inflation there, and also the shortage of workers. In something we normally would not have, the tariffs are coming in. For instance, Walmart had added to many of the trinkets that they serve, or merchandise, what do you want to call it, the cost of the tariff. So they went up 5%, 10%, or whatever. So in other words, that itself is inflation there. The producer price index did not move as much, but at the same time, that is coming. In other words, products will cost more this holiday spending season than last holiday spending season, because you do have inflation there, and we just went over that, depending on what items you're looking at, from merchandise, normally at retail stores, to various other things, and the cost of manufacturing these on the American side, not talking about the international side, those things have increased. Therefore, the interest rate hikes are necessary, because according to our seesaw model, these ups and downs, this economy, because of the kinds of tools this administration is using, i.e. the tax cuts you normally don't use, that steeper tax cuts or tax cuts of that nature, unless the economy is in a lower ebb. And also some other stimulus programs they're having, but at the same time, the tariffs, particularly on China, put farmers in the Midwest area in some jeopardy, and then the government had to go and basically subsidize those crops and that money has went out to farmers. But at the same time, eventually the cost of many items will go up, such as steel, and you're now seeing redundancies at some of the roll steel plants. This is normally plants that employ 100 to say about 400 or 500 workers. Some of those plants, because of the cost they're having to pass on to their customers, are causing them to cut back production at many times, and the product is costing more. Say, for instance, something like a beer can is costing more, thus the price of beer will go up, and we to attach ourselves to Mr. Kavanaugh. So these are some of the things that you start to see, period. Now, Credlow on the ABC this week said he didn't think the Fed policy was out of control. No doubt about that. And Lawrence Powell, the new head of the Fed, that was picked by Trump, and he didn't extend Janet Yellen, Dr. Yellen's term. But this guy is basically a business-friendly person, so thus he caters, and the banks are making a lot of money off of this. So you just see the banks moving on with it. Let's get to petroleum. That's another part of it, and we have the International Energy Agency, which represents consuming countries. Global consumption to increase about 1.36 million barrels over a day next year. That's a lot less than we become used to since the price crash that was in 2014, and a more pessimistic outlook Iowa Group has backed in July. The old story was that basically petroleum usage would be up, and even if you factor in the Iranian sanctions, etc., they would be off market. You still have it going on here, period. And according to Atkinson, I'm not sure who Mr. Atkinson is here, the report sums up in 4 words: expensive energy is back. Now, when you factor that into, with, say, for instance, with consumers, you have less discretionary income. And that is a direct result of overproduction in the Balkans and various other places. That's in the Dakotas and in Texas and those places. The U.S. is now an exporting energy type country. But at the same time, you have Saudi Arabia, the Russian Federation out there. Venezuela, a lot of their production is offline. But still, the world is manufacturing less, basically speaking, there. And China's is moving in a different direction. For countries like India and China, the major source of demand growth, the weakening of their local currency against the dollar is, and that's another problem. We haven't mentioned this in the telecast here. Impacts of the rise of crude rise. So again, strong dollar makes exports more expensive. Drivers in India were paying record prices for gasoline and diesel earlier this month, even with crude oil still at 40% below the 2008 peak. That prompted the Indian government to cut tax on fuels and state-run oil marketing companies to absorb additional price cuts. Chinese drivers have also seen prices rise by 28% over the past year. So some of the things going on here. So you have an energy going up at the same time. You have the effects of the tariffs. You have an inflationary economy. And back to India, exports have fallen by 39%. Since the sanctions on the sanctions on the country, they come into force on October 14th. OPEC and Russia have struggled to offset the drop in Iranian and Venezuelan output. Even with Russian output at a post-Soviet high after the Soviet Union, Saudi Arabia producing near record amounts, Libya pumping more than it's done at any time in the past 5 years. Libya remains unstable, literally, and Nigeria is scheduled to hold elections in February. And in the Nile River Delta problems there, the IDA puts OPEC's spare capacity at 2 million barrels a day, but most of that either hasn't been tested or assumed on political situation. So this is a very iffy situation. I'm looking at the International Monetary Fund, at the International Energy Agency here. Both global oil demand and supply are now close to new historic significance peaks at 100 million barrels. Neither shows signs of ceasing to grow at any time. 15 years ago, forecasts of peak supplies were in the range with production from non-OPEC countries supposed to have started decline by now. But in fact, producers have surged, led by the U.S. Shale oil revolution, they call it, supported by big increases in Brazil, Canada, and elsewhere. In the future, a lot of potential supplies could come to the market from places like Iran, Iraq, Libya, Nigeria, Venezuela. In their various challenges that can be overcome, there's no peak in sight for demand either. Drivers of demand remain very powerful, with petrochemicals being a major factor in the new IEA study. The future of petrochemicals, the agency points out that raising living standards, particularly in developing countries, already underpinning strong demand for plastics. That is not a good situation. This will continue with many years to come. As the oil market reaches landmark 100 million barrel level, prices are rising at a steady pace. Brent crude oil is now established at over $80 per barrel, with infrastructure constraints causing North American prices to lag somewhat. That would be the Texas part of the scenario. Needless, our position is that expensive energy is back, with oil, gas, and coal trading at multi-year highs, and poses a threat to economic growth for many developing countries. And this is the reason we include the IMF piece. Higher international prices coincide with currency depreciations against the U.S. dollar, so the threat of economic damage is more acute. The global economy is also at risk from trade disputes. We've mentioned that a few times. Revised demand outlook reflects these concerns. Growth in 2018 and 2019 will be roughly at 110 barrels lower than an earlier forecast. As expected, demand sectors this report has also impact from methodology changes to China. And elevated price. I think we'll go ahead and include this in our rundown here. And let me see, we've already talked about that. We've covered the IMF. And Sears. Well, Sears has a lot of trouble. They have empty shelves, poor customer service. They're in bankruptcy. They're going to close probably 150 of their stores. A sign of his corporate power was a 110 store. Remember that? Used to actually have an office in the Sears Tower. The world's tallest building for a period of time. Well, it's no longer there. And this shows you what can sometimes happen. According to former workers, it started going downhill in 2005. That was before the Depression. Consumers used to be able to check out any department stores. There was always somebody to assist people. That's according to somebody named Judy Davis. She's 81 years old in Banning, California. She retired from Sears in 1999, worked at Cerrito, California store for 27 years. And basically the story is the same. Look at what happened to J.C. Penney. Launching a new, what brand Penny is doing. The problem, Penny and these places have had problems. From Levi Strauss, which owns Levi, said it still supplies to Sears, which owns... anyway. So some of the things happening here, in other words, Sears a disaster area coming. We talked about Wells Fargo, making this the fourth largest bank by assets, chopping billions of dollars of costs. Cost cutting is a big thing. The non-interest expense fell 4.1% in Q3. That's $13.8 billion in year-over-year decline. Loans fell 1%. They were falling more to $942.3 billion. And there is no, as they say, Christmas holiday for these characters. Big changes in equities, and no doubt about it. Ended the quarter with $1.88 trillion in assets. Its average total deposit declined by 3% to $1.27 trillion under the Fed's 1.9% asset cap. So we're starting to see some movement there. Walmart made a settlement in California with cashiers, $65 million, with 100,000 current and former cashiers there to provide them seating. So now let's go back here and we'll do the commodities. This is from Bloomberg. The Bloomberg Commodity Index. At 0.37%. Our actual change here at negative 0.65. And the USB Bloomberg Index at 5.25. Let me just, I think we did that right. It's in a very light blue. And actually that's a plus 0.66. Anyway, the Reuters is at 1.36. That's their index. The Reuters International at 12.05. And we look at Brent crude here. Well, Brent crude is at $80.43. And West Texas Intermediate at $70.34. The T-Boone Pickens is still jumping for joy in his retirement. And the gasoline index at 194.20. The natural gas index actually it fell 0.6. The heating oil fell 1.9. Precious metals, gold at $1,222, down $5.60. The spot was at $1,217.05, down $7.04. Silver still ranging at $14.64. It gained 3 cents. Platinum was down $2.69. Wheat was up $9.25. Live cattle, we can't get pork bellies. I'm going to have to find pork bellies. Anyway, it was down 60 cents. That is that part of it. And let's jump back to the BBC, and we'll finish this up as we usually do and do the markets. On the business page here, Cannabis in Canada, we know the world is watching. Well, they are moving forward with that. Big question here. Can Democratic Republic or North Korea ever join the IMF? We'll look at this one and then we'll... Big picture here of Mr. Chairman Un. Kim Jong-un even said he would be willing to join the IMF. That's according to Reuters. These ambitions, vague for now. Well, benefits of membership would give the Koreans access to huge pools of expertise, technical assistance, and funds. Well, yeah, but the problem there is not as good. Aims to the IMF, but to secure financial and monetary stability, while the World Bank seeks to foster economic development and reduce poverty. Both of these are based in Washington, D.C., Western institutions. And we would see, though, measuring on usual economy, not only does the Koreans not publish economic data, but it's an important black market, rampant corruption. Well, that's... you see that everywhere. And let's see, that's the end of that story. So we'll go to market data here. A good way to segue away. And we'll get the markets here. Let's see what we got going. The FTSE 100 was down negative 0.16 1/16%. Or not 0.116%, get it right here. In Amsterdam, they were also down a negative 0.31. The calc was down a negative 0.20. Percentage of Eurostat was down a negative 0.46, and in Spain they were down 1.18. The Dow was finally at 1.15%. The Nasdaq at 2.29% there. And in Chicago, at 1.24%. All these were positive. The Senex was at 2.15%. The Hang Seng at 2.12%. And the Nikkei at 0.46. They're obviously all positive. We won't get into the currencies here. Brent crude was up 21 cents at $80.43. We basically had this and we gave gold. So let's see. Well, they got the Forex here at $1,218.75. Basically the same thing. The change, well, and they have natural gas, a little different there. Henry Hub futures, it was down 1.89. A little more financial statistics coming at us here. And we have exhausted our time. A little over, not too bad here. But to sum this all up, I'm basically speaking, producer price index is up. And at the same time, it appears, particularly in certain products, food, energy costs are up. So thus, those are up will affect inflation. So you can expect the Fed to raise interest rates in its next setting. I believe that will be a December meeting, probably when that happens. There have been projections from the Retail Association of 4.5, 4.8 increase over this holiday season. If that does happen, or even if, say, for instance, they have 3.5, 4, because of current pricing. Now, obviously, you'll have what they call loss leaders, big screen, whatever type TV sets for $300 and what have you, a few. But and also Walmart has started their holiday season already. So it's you'll have to look at pricing where the price of many of these items, providing the SKUs, or what do you want to call them, that were available last year. Obviously, they're new SKUs. But at the same time, say if the price of an item was 10, 20, or 30 cents more than it was, say, last year, even at the discount rate, then you have some inflation built in. You're going to find this happening, and we'll look at such things as auto sales. We've spent some time on those. The 2019 models are creeping off of showrooms, but they still have a supply of 2018, and in some instances, there are probably some 2017 models sitting around on some lots that are not so-called pre-owned. They've never been driven off, or they've been diverted to other markets in other countries. But it is a slower rise than normal for the automobile industry. And we'll be looking at such things as food, out, in other words, people that are eating out, is that the expense of that, of course, has went up as the various parts of the menu costs have went up also, and in some instances, labor costs. Are there more people, fewer people? Those are some of the questions we asked. This will end it for us. So those are in business, making it productive next week. For the consumer, obviously, the eyes are on the prize, as in the consumer index. And another note, as we move more closer and closer to the November midterm elections and the excitement there, where will the economy go? The market has kind of climbed out of the huge losses, and we didn't have that in here. We should have. But the market lost over 1,400 points, and that was a continual thing. Some would say it's an adjustment, but some things on the market, for instance, Facebook, etc., in this new communications sector, have been riding high, but they've started to lose their steam. And where will some of those things go as the consumer economy goes? They will go. In other words, there will not be as much revenue advancement there. We don't see that at Cranston Analytics as to where that will go. We've been expecting for a very long time some of the basic components of that index, i.e. Google, Facebook, Twitter, in terms of their ad revenue, and in terms of particularly regulations in the EU, and the impact of the 29 million breach that just happened. Not very secure, and they got more than just basic information. They were able to get such things as telephone numbers, things that you supply to, say, Facebook, to quote-unquote secure the account. Those kinds of items there, education levels that people have obtained, and whatever types of information they put their so-called personal information, including their contacts. And that is just open for a fishing expedition there. So these are the kinds of things that have been trending on social media. Some people have put their accounts on holiday. Other people have skirted away there. So these things are coming up. And also the whole idea of privacy and where the ads tend to pop up. Listening to a baseball game on radio, we hear it breaks more and more ads inserted into the broadcast. The thus and thus scoreboard, the thus and thus relief change, and all these little things built in. The old adage used to be the station break, for 10 seconds, but it's beyond that. Just the insertion of more and more ads. The same thing happening on social media. People are using blockers to block those out, and a lot of the sites out there want to track you. And if you're using browsers as we do, like GoDuckDuck, they cannot track you. So that is part of their puzzle. And we'll be looking at studies to see where that's going.